Investors hope that record-long U.S. government shutdown will finally end. The U.S. House of Representatives has to pass a spending package extending government funding until January 30th. Now, that optimism over the end of the shutdown is helping to lift the markets this morning. Let's get more from Ross Healy, chairman of Strategic Analysis Corporation. Ross, great to see you. Thanks very much. Give us your thoughts first off on the U.S. government shutdown. Do you think it is a big issue for investors right now?
Not particularly, because it's heading now towards the ending. I think probably the biggest thing that we might anticipate as far as the shutdown is concerned is what kind of retribution, if any, that Trump decides to unleash on any of the participants.
Oh, you mean in particular the air traffic control people who didn't report for work?
Yes, exactly. You know, those kinds of things. I don't think that the shutdown really affected much. It put off some issues, but outside of that, not much. The big thing I think coming up is the implementation of that big beautiful tax bill, and the impact that it's going to have on the U.S. balance sheet. That's what I'm really interested in.
In the sense that will it make the budget deficit soar and cast shadows over the U.S. debt load?
Yes, exactly. That's it. And if you look at the impact of that on the budget deficits in 2026 and 2027, it's just absolutely enormous. And given the fact that the U.S. balance sheet is already quite weak, the impact could be quite strong. It is no surprise to me, Andy, that the price of gold, first of all, is at the levels that it is, but also that it's kind of now oozing higher after that 10% setback that it had.
You have a somewhat cynical take on earnings season, Ross. Oh, I can't believe it. But let's call it mildly jaundiced. You say that companies beating earnings expectations, there's a major element of theater there.
Oh, listen, if you had an investor relations person working for you, and you didn't, when your earnings were reported, you didn't beat expectations, I would fire the investor expectations person. His job is to make you look good, and therefore his job is to steer the analysts to a level of earnings forecasts that you will be able to beat. Unfortunately, it's not only something that has been going on recently, but it's been going on for years and years and years. It used to be, be 50, 60, 70%, but now the numbers are 80% plus beating expectations.
We hear a lot of talk about the Ford multiple on the U.S. market in particular, around 23 times, maybe higher last time I looked. But you say investors should be paying attention also to the price-to-book ratio. Just enlarge on that, if you would, Russ.
Yes, they did. They should, Andy. And I've got quite extensive data going back a long way on the valuation of the market. In 2000, the Standard & Poor's reached a price to book. We adjust the book, so it's 4.5 times book, but is roughly, say, 5 times book, which it reached in 2000. Well, it then spent the S&P spent an entire year there sort of banging up against it before it went into the tank. This year, we got up there early on in 2025. It got there and the market said, oh my goodness, look at that. It's back up to its old high. And wham, it came down. Remember, we had about a 22% decline. And then it's been oozing back up again. Well, we're back up to that level again, that in our valuation mathematics, that's a very important level. Breaking out there, which it is now trying to do, carries quite good implications for a further gain for the market, probably in the order of 15 to 20%. So I am very loath to be running for the hills and selling everything because I think that the market is trying to break out, and those good earnings, Andy, those good earnings and sales numbers which you're beating are the kind of thing that feeds into that air of positivity. I pay a lot of attention to it. Some people pay a lot of attention to those valuations, but I suspect that the rank and file investor looks at the numbers and says, gosh, those are good, and so we can buy successfully, and they push the market further. Well, they could really push the market, as I say, another 15 to 20% from here.
Sorry, so just give it, what was the relation to the price to book there, Ross? Give us that again.
Okay, it's about in unadjusted book, it's about 5 times book. We adjust the book, so it's precisely 4.5 times book there for the Standard & Poor's, and that was the peak in 2000. It was the peak at the beginning of this year, and that ceiling now looks to be breaking higher.
Oh.
It's fascinating to watch it because it could be very, very bullish for the market.
I see. Okay, so even though it's high, you think that the fact that the market's willing to push through that ceiling is at least in the near term an optimistic indicator.
Yes, I think it well could be. You know, when a country has a very, very poor balance sheet, the way that the U.S. does, very weak balance sheet, you have to look at what are the balancing factors of a poor balance sheet. And historically, the balancing factors have been gold and silver, and of course they've been doing well. But the another element in other countries where this has happened has been the stock market, and in particularly quality industrial companies, and we are seeing strength there too. So we're enjoying strength in gold, and I think we may be enjoying strength in industrial companies as well.
Ross, thank you very much indeed for joining us. Ross Healy, Chairman of Strategic Analysis Corporation.